Thank you, everybody who's dialed in today. It's great to be here and to speak to you. And I hope that we will have a very satisfying and fulfilling conversation now. I'm very keen to share with you my latest thoughts and also explain how it is that we come to put the portfolio together. So if we start with the first slide, this is a summary of what we are intending to achieve with this portfolio. At the moment, we believe that the UK equity income sector is particularly attractive. You will know from all of your reading over the last 5 to 10 years that the UK, there are many reasons why the UK has fallen out of favour. It's now actually receiving lots of attention from government, from policymakers, that there has been this drought in new capital coming into the UK market. And as a result of that, we are seeing some extraordinary valuations in the UK, and that's actually spurring significant M&A activity. We've had 4 different deals this year in our portfolio, 4 companies that have been bid for. So it's a very interesting time to be investing in UK equities. And of course, the UK equity market stands out because, as you will also well know, dividends are a particularly important component of our total return in the UK equity market. If you look at the statistics, it's around about 2/3 over a 20-year rolling period of our returns come from dividends. Now, that's very different for other markets like the US, and you'll see that there's a greater reliance on capital growth, which has been forthcoming in recent years for the US market, but we all know that market conditions can change and do change. So the UK payout ratio, currently about 50% payout ratio, about 2 times dividend cover in the UK. And we think that as the economy starts to recover, now we've been waiting for that for a long time, haven't we? But as the economy starts to recover, we need some confidence for that to happen. But then dividend growth can resume in the UK. Now, in terms of Aberdeen Equity Income Trust, what makes us different? Well, we've got a particularly differentiated and diversified portfolio. That's been the hallmark of the portfolio really ever since I started managing the portfolio in 2011. I have been managing income money since 2009. I started in the industry in 1998, and I've been looking at UK equities for almost that entire period of time. So 26 years now in the industry, most of which have been looking at UK equity income. The investment philosophy is all about looking for change in company fundamentals, and often that change, we believe, is overlooked. So at the moment, when everybody's worried about the macro and about politics and about whichever crisis is currently in the news, you will see that there's been this incredible mismatch between the reality of all the good cash flows and earnings that the companies are producing and their share prices. And hopefully that's what motivates all of you in your personal portfolios as well. So that belief that actually markets can be inefficient, and that's particularly true when there are big periods of macro change. So we are an AIC dividend hero. We've been growing the dividend for 23 years. I certainly don't want to be the portfolio manager who sees that changing. We currently have a dividend yield of 7%. We are confident we can cover our dividend. And that's important because that should give you confidence that that track record of dividend growth can continue. And our yield, we believe, isn't something we're having to stretch to achieve. We're achieving that yield because of all the higher yield opportunities that we're finding across different sectors. And we see potential over time, especially when the economy picks up, for earnings to grow. And I'll explain to you how that comes together as we go through these slides. So if we move on, Pavlina, to the next slide. Yes, you can see here the growth in our dividends. Well, this is an 11-year period. We've been growing the dividend throughout this period. You can see that the dividend per share in light blue there, those bars. Now, of course, the reality of Brexit, COVID, Ukraine means that the dark blue, which is the earnings per share, that's our portfolio income less costs, really per share. Now you can see that that has been more volatile in recent years. And you'll see that the most recent bar, that's just our 6 months. So I should make clear that when we get to our full year, which results, which will be in November, you'll see that the full year outturn. That's just over 6 months. And I should also say that typically between 30 to 40% of our income is generated in the first 6 months of our year. We've got a September year end, so we're coming up to our year end now, which is why I'm able to speak with a reasonable amount of confidence, because I can see the numbers as they happen. And you can see that we've in the previous year we covered our dividend 1.03 times. So we managed to grow the dividend per share and cover the dividend. And we do think that the dividend outlook is gradually improving. And so as confidence rebuilds, that will help us give us that following wind that we've perhaps not had, or it's been very choppy for various reasons I can go into as the conversation continues. So if we move on to the next slide, you can see here, this is what we're trying to achieve. So I'm going to tell you about my investment objective, and you'll see how these three aspects fit with the investment objective. First thing to say is that we are high yield. We're unashamedly high yield, and you'll find that actually some investors really value that. So the 7% dividend yield is something that you won't get very many places around the world. You can get that by investing in UK equities because we have so many companies which are generating huge amounts of capital. Second thing to say is that we are looking for growth in our dividends. Now that will be mixed from sector to sector, stock by stock, so we've got to be selective during the course of any given year. But over time, we think that corporate earnings will grow, and that will help us to achieve our objectives. Now, the final thing is valuation re-rating. Now, obviously, you will know, and I will explain how cheap many UK equities are at the moment. There are companies complaining really that they believe they're just as good or better than other companies all around the world, and yet they're trading on valuations which are just ridiculous, mid to high single digit price earnings ratios. Now that's something which those of you who've been investing for decades will know doesn't always stay for very long. In the end, if they're good companies, they will get noticed, and we will see those valuations re-rate to a higher level. And I can talk with you today about some of those names where we're expecting that to happen. So if we move on to the next slide, you can see here how we've composed the portfolio. And I wanted to bring in here the objective that we're looking to achieve, which is providing shareholders with an above average income while also providing real growth in capital and income. And this is how I structure the portfolio. This is how I think about each of the stocks in my portfolio. So at the moment, we have got between 50 and 60 stocks at the moment. You can see that how we've composed the portfolio. It's really 40% in stocks where we believe there is clear evidence of clear dividend growth. So we're not relying on high commodity prices. We're not relying on good economic outturns. We believe these are companies that are capable of growing their dividends, and that's on the back of the investment research we've done. We believe those corporate fundamentals are there to deliver those growing cash flows over time. And I'll talk in a moment about one of those companies, Galliford Try, which is a construction company. And I'll explain why I've got confidence as the portfolio manager, and why the team has confidence that a company like Galliford Try, exposed to UK construction, can grow its dividends. Second, in the middle, you can see mispriced yield. Now, some of you will look at that median yield of 8.6%, and you'll say, sharp intake of breath, and you'll say, that's too good to be true. Well, there are stocks yielding more than that. There are stocks yielding less than that within this basket. But in any given year, those stocks will vary. Some of them will be paying special dividends, for example. Some of them will be benefiting from particularly strong fundamentals. We saw that during the Ukraine war, when the outbreak of Russia-Ukraine war started. We saw commodity prices surge, we saw gas prices surge, and coal prices surge, and oil price surge, and that was a boon. That was a windfall for many of these companies that we own in this portfolio. And so we got a huge windfall in terms of our yield. And a lot of those stocks are what I would call mispriced yield stocks. If they won't repeat their dividend year after year. Some of them will have higher dividends one year and lower dividends next year. And I'm thinking here about some of those resource stocks. But then others within this basket, stocks like Chesnara and other financials companies, have actually had a really good, strong track record of growing their dividends. So arguably, Chesnara could be in either of these two categories, income growth or mispriced yield. The reason I included that in mispriced yield is that Chesnara, which is a closed book life insurance company, which is very conservative. If you've ever met the management team, or watch them on their webinars, you'll see these are really conservative people who are not going to overpay for the assets that they're buying. They are a low-cost outfit. They really don't splash money around, and that enables them to be very lean and efficient. And they are yielding 9%, actually over 9% at the moment. So that's giving us really good confidence that we can continue to achieve this really attractive dividend yield in Aberdeen Equity Income. Finally, I want to talk about the one that probably excites me the most, because this is the segment of the portfolio that can really generate some really attractive capital growth. And this is unrecognized change. And what I mean by that is companies where there is operational change that's happening, which has been overlooked by the wider stock market. Now, here you are looking for companies where perhaps the market's decided they're just not interested in these stocks because they think to themselves, no, stock like, let's talk about a couple of them. TP ICAP. Some of you will have known Talit Preborn many years ago, stock business that was run by Terry Smith, who now runs Fundsmith. And they merged with ICAP, which was run, it's a separate business. Both very well regarded businesses. They came together. They became the largest broker in areas such as fixed income, credit, commodities. And this is a business that I'm going to talk a little bit more about later on. Some of you will know Quilter as well. This was a company that was going through a tough time about 2 or 3 years ago. They had a problem with their platform and they had to use FNZ, which is a New Zealand IT company, to help them to improve their investment platform. That really transformed their prospects. And so what can happen with these stocks, which we really enjoy, which really gives us that powerful move up in our NAV, is when that happens, particularly when it happens at a time of risk taking, when the market's decided it's no longer as risk averse as it was. What can happen is that the valuation that the market applies to these stocks can go up, can re-rate, and at the same time you can get earnings moving up. And when those two things happen together, that's the really big move in share prices that we can see in this portfolio. And we are laser focused on identifying those names. It doesn't always work in every market environment. So when the market's when the market's depressed about the macro, whatever good news you throw at the market ignores it. But in the end, when the market stops worrying about the macro, it goes back and looks at the fundamentals of these sorts of companies and said, why are those companies still trading on 8 times earnings or 10 times earnings, whatever it is? They should be trading on 15 times earnings. And you can see how powerful that can be. So I'll give you a couple of examples of that in a moment. So if we move on to the next slide, and I think the stock examples will help bring it to life. So Galliford Try, we all know that water, for example, which is one of their largest markets that they operate in, our water infrastructure in the UK is lamentable. And if any of you've got kids or grandchildren, and if you live down on the south coast, you'll be looking now at the Surfers Against Sewage website, and you'll be looking at let's see how polluted this beach is before you go into the go for a swim. That's appalling, and it's something that needs urgent action. And clearly, many years of underinvestment has caused that. So these companies, not just Galliford Try, but some of you may know Kier Group, which has been through a lot of difficulties. We don't own that one. Balfour Beatty is another good one. I mean, these are companies that are exposed to the increasing demand for capital expenditure in areas such as water. So we discussed this as a team when it demerged from Vistry Group. It used to be called Bovis Homes, you'll know, and Bovis merged with Galliford Try's house building division. They got together, and that left Galliford Try as a standalone business. Now, at the time, the chief exec of Vistry was saying, "Look, I really like Galliford Try." I can remember speaking to him. And Greg Fitzgerald, his name is, and Greg sort of shoots from the hip, and he said, "Look, if I could have kept Galliford Try, I would have done, because it's a great business." We'd had a history of investing with them, but they'd had a couple of blow ups. They had a problem with the Aberdeen Ring Road, and they'd had a problem with the Forth Road Bridge, which were fixed price contracts. They'd underestimated how expensive it would be to build out those projects. So the company needed a huge dowry from Vistry when it demerged. So Greg Fitzgerald had to put in his hand in his pocket and say, right, you take 100 million. So Galliford Try was net cash. And that meant that from the word go, we knew that this was a much better quality business than the market actually believed it was. And then since then, they've built up a really lovely stream of new business. If you look at their presentation online, you'll see the percentage of their business that they know they've already achieved at the beginning of each financial year. So on January the 1st, they've already been awarded around about 85 to 90% of their business for that financial year, which means they've got huge visibility, they've got net cash on the balance sheet. And so the confidence that these guys have got in growing their dividends is phenomenal. So for me, this sort of company, which has been written off by the wider market, Galliford Try, you can see that from the share price when it demerged from Vista, it went from £1.50 to about 75p at one point. And we've actually been topping up in this, and there's a capital markets day in May this year, which I attended here in Liverpool Street actually. Fantastic opportunity for the chief exec. He really took the ball and he ran with it. He went and explained to all the analysts at these capital markets day why it was that he had confidence that they could achieve new targets which he set out, having already achieved his 2026 targets 2 years early. So these are sorts of good news stories with underappreciated change, which we are looking for in our portfolio. And the fact that there's a nice yield on that too, 4.7%. It was a lot higher actually a year or two ago. But of course, when the shares move ahead, as this one has, the yield comes in, and that means it's working. So if we move on to the next slide, TPI cap, I did mention this a bit earlier, and this is another of these change situations. The yield's about 6 on this one. A lot of people think that if you want data, which everybody's terribly excited about data at the moment. So if you look at London Stock Exchange, it's all about the value that their data brings, and because of course they can monetize the data by selling it off in packages to not just people like Bloomberg, but all around the world. That data is hugely valuable. Now, what people didn't appreciate was that Tullett Prebon ICAP operates in markets that are far deeper and bigger than equities. TP ICAP operate in fixed income, which is multiples of equities in terms of the size of fixed income markets, credit, commodities. Now, because they're the number one, if you want data on any of these types of asset classes, you've really got to go to TP ICAP. They recognize that in about 2017, they set up this division called Parameter, and they're thinking of partially floating this business. And it's likely, sadly for the UK, it's likely that it's going to be floated in the US. Now, can you imagine what sort of valuation the US investors are going to put on a pure data business with the largest market share in all these different huge markets, actually bigger markets than equities? So I think this is one that the market's completely got wrong. They've not understood that this is effectively the LSE Mark II, and the fact that they're actually also performing really well in their core business, which is a platform for dealing volumes in government bonds, credits, oil, commodities, all these different. Now, because QE ended, what that meant was instead of everybody sitting on their hands, suddenly activity came to life, and it's remained strong. So QE put a dampener on everything. You could just sit there and you didn't need to do anything. If you were a company treasurer, why would you need to refinance your debt? You didn't need to. If you were the government, you didn't need to do anything. Now they're doing QT, which is actually releasing bonds back into the market, which of course means that the pool of securities that a company like TP ICAP can deal in is going up every year, as QE becomes QT. So really, this is a good news story, and of course volatility, which we tend to fear as equity fund managers, is something that normally should be good news for a company like TP ICAP. So that's one that I'm particularly excited about. You can see I topped up in that one again fairly recently. I'll explain to you, how I decide where we allocate the shareholders' capital. But really, we like companies with a combination of value and earnings momentum, and both Gallifrey and TPI Cap have got those two in spades. So if we move on, the final one I wanted to talk about today was Quilter. Now, this is a real inflection point. You can see, yeah, it was a business, as I mentioned earlier, that some of you may know Quilter Cheviot, which is their wealth management business. The fact that you're doing your own thing, at least partially, suggests that you are sophisticated investors who are taking your own views, but you are in the minority. Of course, most people feel they need advice. The vast majority of people we're talking about here, because there'll be moments in your life when there's a big life change, perhaps a family member passes away, or perhaps you retire, lots of different events where you might need advice. And so Quilter Cheviot and the advisors force that they have, they're number two to St James's Place, who of course are getting themselves into all worlds of trouble at the moment with regulation, which is not unhelpful for Quilter that the largest player in the market has got itself into that situation. So we've got a situation where Quilter Cheviot is the wealth management division. That's faring okay, but the real excitement is the advisor business and the platform. And the platform is really, they operate, is a really quite a capital light business, because they provide their platform services to financial advisors, whether they're tied to Quilter or whether they're independent, and that really has been growing its market share in the last 2 years as they've finished their very heavy IT transformation, and they've rolled out this new platform, which is going down very nicely. It means that their advisors can hold more assets with Quilter. So there was a mechanical earnings upgrade here, because their previous platform was so archaic that even their own advisors couldn't hold their assets on the Quilter platform. It was that archaic. So this really, we could see this turnaround happening, and that's why we bought more shares, and it's really an upgrade story now, and it's not that expensive. I think the turnaround. I actually met the management team. I met the chief exec yesterday, and the finance director, and I asked them that question. I said, so, now that things are getting better for you, how much more cost are you going to need to put in? And the answer really is not much at all. It's very operationally geared, because of course, if your assets under management goes from 100 billion to 110 billion, you don't have to, there might be incremental cost, in the sense of, your advisors might be slightly busier, they might have a few more clients, but actually the platform is pretty scalable. So they believe that really now earnings can come through very, very nicely as the assets build on their platform. So that's the third example. Now, if we move on, I want to talk about the portfolio as a whole, because I've talked about three examples there. Now, the market caps of the companies I'm investing in range from tens of millions to hundreds of billions. And that's the beauty of the UK equity market. We do have a very broad and deep equity market. Now, if this fund was based in another equity market, it might not have that range of opportunities. The UK, although the headlines are we've got fewer stocks listed here than we did 10 years ago, we still have a huge number of opportunities. And I think that's visualized. Hopefully you can see that with this scatter diagram that I've put in, because you can see on the x-axis the market capitalization of the stocks we invest in, and on the y-axis you can see the dividend yield of the stocks that we're investing in. And really there's not much correlation there between the size of the company and the yield of the company. We're finding yield all the way up to the largest cap stocks and all the way down to the smallest cap stocks. The allocation, it's really a function of our conviction in the stock. So we've got just over 50% in FTSE 100 names, which you would know well. We've got just under 30% in mid caps, the FTSE 250, and then the rest is small cap, AIM, and stocks which are listed in London, but not necessarily in any index. So that is the mix. So it's about 50. And then, it's not far off 50-50 between large cap stocks and small and mid cap stocks. That's a function of the available opportunities. Right, moving on. Slide 17. You can see the top 10 here at the moment. So we've updated this to the end of August. So it's a pretty good reflection of where we have conviction at the moment. And as I'm sure you've already sensed, I'm pretty excited about some of the ideas in the portfolio. And we can during the Q&A session, I think we can go into some of these in more detail if people are interested in them. You will see here there are some sectors that you can see are generating particularly attractive income. You can see sectors such as mining. You can see sectors such as financials in there. And I should also add one point here, which is that when these stocks play out, their yield obviously comes down because they will be growing their dividends. But if the share price goes up as we expect them to, the yield compresses. And that's the investment process in action. When we bought these stocks, they weren't yielding as little as this. They were, so I look at these yields and I think to myself, well, actually, good question to ask yourself at any one point when you're investing is, would you buy this holding today from scratch? And if the answer to that question is no, you really need to question whether you should still be holding it now. And that played out very nicely with Hargreaves Lansdown as an example. It's a stock which has been bid for by private equity, CVC partners, and Abu Dhabi and a Nordic capital partners as well. So what we've got is we've got a consortium of bidders, including the founders, coming along and bidding for this stock. Now, a year ago, it's hard to believe, but the market leading investment platform, which many of you will be using, was yielding over 6%, and it was on a PE of 11. Now that's ridiculous, and it's really keeping alert and staying in tune with these ideas and these opportunities is key here. 4%, you can argue it's still not expensive, but at £11.40, which is the bid price, seemingly less likely there will now be a counter bid, which is somewhat disappointing, I have to say, because I was hopeful that there might be a bidding war for Hargreaves, but that didn't happen. But you can see how the re-rating from 11 times to whatever it is now, high teens PE, 6% yield down to 4% yield. That is the process in action. And so some of the names at the top end of the portfolio can be lower yield simply because they've worked out. And at that point, we then need to question, are they still appropriate for the portfolio? Moving on to the next slide. I don't want to run out of time here, and I'm sure Mike will tell me if I'm getting close to the limit. But
I think you're okay for another 5 or 6 minutes.
Okay.
So
thanks,
yep.
Mike. Thanks, great. So you can see here we've tried to segment the portfolio down into different geographical areas. So this is based on the company accounts, the revenues that each company achieves, and then you aggregate that and do that and our systems allow you to look at where are our companies generating their sales, and the answer to that is, well, just under half UK and then just over half the rest of the world, pretty evenly split between the different continents. Then on the right hand side you can see how we're positioned in terms of our sectors. I'm going to gallop through the next few slides because I want to make sure I don't miss any of them, given we've only got a few minutes. So the next thing to say is the yields in the portfolio, these are median, so it doesn't, we could have a higher weighting in a higher yield stock, for example, or we could have a lower weighting in a lower yield stock, but we've just simply done median here, which just keeps it so nice and simple. The PE, a median PE of under 9 times, median dividend yield of 5.5, dividend growth, free cash flow yield, return on equity, price to book, and gearing. Now, I don't change these. If you've been along to one of my annual general meetings, you will see I present this slide at the annual general meetings. I'm just encouraged that the numbers look like we're on the right side on each of those metrics. Again, moving on, just in the interest of time, I think the equity markets from here, well, certainly so far so good, post the rate cut that we've seen in the summer, we are starting to see some signs of confidence building. And what we're showing on the left is what the economist at Goldman Sachs anticipates interest rates will turn out to be. Now, clearly, all we know about the side on the left is it will be wrong. It won't it won't. But direction, we think, we as a house, we believe that is broadly correct. That there will be gradual base rate cuts over the next few months and years, and therefore, actually the equity market performance that you see after the first rate cut, historically, this is 50 years of data of UK equities, which a house called Berenberg have put together for us, which is showing that over 6 months, you get a very nice total return of 13% in UK equities, and over 12 months, you get a nice total return of 18%. Now, that's obviously there'll be incidents when it doesn't work. It won't be positive every time, but over 50 years, that's on average, that's what you generate post the first rate cut. So it does tend to be a good time to invest in equities. Clearly, all the usual caveats apply in terms of, history doesn't necessarily repeat. Moving on, if we have a look at valuations, again, this is, why UK equities? Well, look, it's UK equity market's trading on 11 times PE. And then on the right-hand side, I think to me, what's interesting is where do we go within the UK equities? Well, we can find PEs, into the single digits. So 8 times PE for energy, 8 times PE for financials. I don't own telecoms. I'm sure some of you will tell me why I'm wrong, but it's an industry where pricing power has not been manifesting itself for some time because the regulators have ultimately got the whip hand there. We do like basic materials. We are starting to see those performing a bit better in the last few days. Thankfully, it has been a while, but China stimulus has been a tonic for Rio Tinto and BHP, and I have been adding to those over the last few weeks. So those are just some sector examples where we're seeing very attractive valuations. Moving on, next slide, we have as mentioned at the beginning, about 2/3 of the equity market return in the UK, unusually globally, comes from dividends. It's not many equity markets where that is the case. And on the right-hand side, one of the challenges at the moment is actually, the dark blue bar here is the dividend yield over time, so all the way back to the year 2000. And it's been as high as 5 at one point during the great financial crisis. We're currently just under 4. And you may say, well, ho-hum, it's not that exciting, is it? A yield for the market of just under 4. But on top of that, you've got this thing called a buyback, which means that companies are saying, our shares are cheap. We think now's a good time to be buying back the shares. One of the things which politically is unpopular about that, of course, is that they're not investing as much as they have done historically. They're buying back their own shares because they think they're so cheap. So I'm going to move on to the next slide. We can talk about any of this during the Q&A. Of course, what we're seeing is as a result of all of that, we're seeing moments at which investors are saying, we like what we're seeing here, and the shares have traded occasionally, at a premium, and that's been very welcome. We managed to issue 200,000 or 300,000 shares last year during the course of the year, so we did grow the trust, and that was very helpful. And we hope that we've talked a lot about what it was that came together at that point, and I think that some of those things still hold true today, which are that we can produce good performance. It hasn't been the case for some consistently during this macro wobbles, but when we show we produce good performance, when this investment approach really comes through, and we're delivering the yield, that makes us quite unusual. So when we've spoken to our shareholders, when we've spoken to our advisors, what they've tended to agree is if we can show combination of yield, but not just yield, but we can show dividend growth, we can show performance, NAV growth, that's when we'll see the discount starting to edge in towards parity again. So I do think that will be icing on the cake. I can't control that. All I can do is keep delivering the income, keep trying my very hardest to deliver on NAV, which is not always within my grasp because the macro does come along and with left field events from time to time. But if we can do our best to identify interesting stock situations like the ones I mentioned, that can help. And altogether, that I hope will deliver NAV growth, consistent track record of dividend growth with a yield of 7, and then importantly for me is closing that discount in towards parity again, because that will be evidence that we are being commended, I suppose, for what we're doing, which hasn't always been the case over the period I've been managing the portfolio. I do need to see that discount closing in, and I'm very, very ambitious to achieve that. And I think that could be additional return on top of whatever we deliver on NAV and yield. So I think that unless you want to, should we move forward to the next slide just to make sure I've not. So that's just a summary slide, which is the final slide, which I went through earlier. So I'm going to pass back to Mike now.
Okay, thank you, Thomas. Quite a lot to absorb there. So I'm feeling quite breathless after all that. I'm sure we've got quite a few questions coming in. Everybody, just a reminder, everybody, keep typing away. If you've got any questions you want to ask Thomas, your big chance to get him get access to him. The first question we've got up here is from David Hallow. It says, can your methodology beat the FTSE 100 total return or the all share?
Well, yeah, is it the certainly that's the ambition. Now we were doing that handsomely for many years, and I would like to give you a potted history of so to give you an idea of the market conditions in which this process really thrives, because no fund manager can hand on heart say we know we will outperform the FTSE All Share or the FTSE 100. They would be lying if they'd said that. Now I can tell you the market conditions in which I think we would stand the very best chance of beating those indices. And I'll give you, if I go back into the mists of time, because we had this phenomenal period, we really where this process really shone, and it was for much of that 2010s decade. So if you specifically, if I zone in on, I've been managing OEIC money as well, I've been managing other vehicles, really the period up to about 2017 or 2018, it really felt like we were on the winning side with most of the positions we had on. Something happened in about 2018, and I don't even think it's Brexit or Trump. I think it was something else. I think it was when, I don't know if many of you follow bond markets, but what we saw in about 2018 was we saw this sudden dip in bond yields to extremely low levels, and actually you'll see over the stories about Danish mortgages were negative at one point. This was a really unhelpful period for this portfolio, and I think that when I look back on that, I think the thing I missed, which caused me to underperform for some years, was actually that shift towards growth that accompanied the collapse in bond yields. Now, COVID obviously at first was this big unraveling, but of course what then happened was that sustained this period of ultra low bond yields by another 2 years until the end of QE, when they realized that they had done too much loosening. So I think that those years were the really unhelpful ones, and the reason for that is that we are really at heart, we're looking for value opportunities. So if we're then finding that the market's pointing towards growth stocks, that's really unhelpful, and that was really the period in which we struggled. I think in a more normal economic environment, I don't know, who knows, normal can vary from decade to decade, but really if we could go back to real GDP growth in sort of 1.5–2% sort of region, it seems some way off. Right now we're more like 0.5% GDP growth, but if we can get about that sort of real GDP growth, a bit of investment, a bit of productivity, companies growing their earnings, what that will do is it will broaden investors' horizons beyond just those quality stocks which have got high structural growth, which are really the tech stocks and some of the pharma stocks and so on. That's what we need, because we wouldn't be able to generate the yield we're generating if the market is, if we only invested in those racy growth stocks. So I think, Mike, I don't want to extend the answers any longer than that, but that gives you a flavour of it.
Okay, thank you for that. One from Matthew Ellis here. What differentiates your trust from the other major UK income equity income investment trusts such as Merchants or City of London?
Yeah, well, those are very much FTSE 100 heavy trusts, I believe. Now they will own some mid-cap stocks. And occasionally they'll own a small cap stock. But I think being smaller really gives us the edge in terms of our opportunity set. Now, those trusts have also performed pretty resiliently in the last 2 or 3 years, and FTSE 100 has notably been a significant source of performance during the post-COVID era. FTSE 250 and small cap stocks have lagged, so that's been to our cost. And again, if looking backwards is always, it's perhaps futile, but what we can learn from the past is that we can be fleet of foot. And perhaps I look back and say, well, during those years when nobody was investing in, no, I mean, you've I'm sure those of you who've been investing in small caps and mid caps yourself will know how frustrating it can be when you've uncovered a really interesting idea, but the rest of the market is not buying into it. And I think that that's been writ large across small caps and mid caps. So I think therein lies the opportunity. But I know you've heard that before from other managers. If you've dialed into these sorts of calls, you will have heard managers who look at small caps and mid caps saying, "We've got an wonderful opportunity," whilst merchants and the like carry on investing in their sort of mainstream FTSE 100 stocks. I just think it's been a long time now. It's been really since Brexit, small and mid cap has been out of favour, and I think that will. And I believe it's actually turning this year. We do need to get through the budget, because if any of you own AIM stocks, you'll know there are some fears that Rachel Reeves might change the rules on inheritance tax. So that's been a bugbear for some of the AIM stocks in the last few months. But we get through October and the economy starts to recover a bit. I think we'll find that people will start to look again at the opportunities in the small caps and the mid caps.
Okay, thank you. Just a subsidiary to that, yes, you're much smaller than some of those larger competitors that you've talked about that are in the peer group. At what point do you become subscale in this kind of area? Because there are quite a few investment trusts around the 100 million mark and below that have merged or been closed in recent times. Do you have a sort of is there a floor below which you shouldn't really go if you're going to continue to operate because the way the cost structures are working these days?
Well, exactly. I wouldn't want to underplay how important cost is, and we've got an eye on that. And I know the directors are fixated on minimizing costs, and obviously the bigger you become, the lower the percentage cost. But we have been passing back some fees over the recent years. So the directors have been holding us to account and saying, look, other trusts are trading at similar or lower fees, and we've been able to respond and provide some fee cuts. So we are conscious of that, and we're doing what we can to make sure that this is a value proposition. But I would say on top of that if the bigger you become, the less nimble you are. I've over my 26-year career, I have managed very big products, and I can tell you it's not fun. It's because if I was ever writing a biography, I could explain why that's the case. It means you have to think very, very hard about buying and selling, because there needs to be a buyer on the other side if you're selling, and vice versa, and that limits the size of companies that you can invest in. Now, if you're limiting your investable universe, I think you're also limiting the returns that you can generate. And so there are benefits of being, under 200 million. And I do think, and actually, finally, Mike, I just want to say, one of the reasons why my colleagues asked me, got in touch with you and asked me to present today was, we think individual investors are the future for these for these investment trusts, for this one, for other investment trusts. We actually think, we look at our shareholder list, there's a change every year. We see more and more individual shareholders on the likes of Hargreaves and Interactive Investor. We see a gradual decline in wealth managers, because they are doing it all now through other vehicles. They're buying what's called MPS solutions, which is multi-portfolio service. They're doing all sorts of things. They're not buying investment trusts as much as they used to. Right. So if we're going to exist, we need to engage with ShareSoc and attend conferences. We need to be engaging like this and making sure that we're making, enough effort that we're informing you what we're doing, and if it appeals to anyone, they know where they can buy it.
Mm-hmm. Okay, no, thank you for that. One for Tom Dury here. You are clearly investing into areas of the market overlooked by other investors. How long to run with your stocks if they do not deliver against your target returns? And looking at this another way, what is your average hold period?
Well, I mean, a lot of the stocks I own have been in the portfolio for some years, and I think when we last looked at it, it was something in the region of 3 to 4 years that the average holding period. I think it can vary. I mean, I think the best example of a winning idea would be one which we buy, which then plays out. And Hargreaves is a good example. We bought it, actually initially started buying it actually above the current share price. But the good thing was, because we've got conviction in it, we carry on buying it. Got down to about £6, £7. That was when we were really buying the bulk of the shares. We thought it was cheap, even even north of the current share price. But so we because we're careful about when we buy, and we've got conviction in it. Those ones, when they play out, then we've got a trigger to sell, and that in this case it was M&A bid. But so that was the ones. And going back to your first question, which was when do we sell when it's going wrong? Well, I think the checks and balances that you need for that, we've all been there. Stocks where you fall in love with them. You need somebody around you to say, look, Tom, you're in an echo chamber. You you're not thinking straight about the stock. And I think that's the important thing, that as a team, I've got people around me. I've got speaking to Charles Luke, who runs Murray Income earlier. I've got, Ben Ritchie running Dunedin Income and Growth Stars. So I've got colleagues who I'm speaking with daily, and we've all got our own investment process and our own investment style, because at the heart of what we do is we live and breathe our investment approach. But we need people around us to say, look, that's not working out as you expect it to, so go back and work out whether you would buy it from scratch today. And that's the ultimate arbiter of whether you should be owning it today.
Okay, thank you. And we've all heard about the well-publicized staff cuts at Aberdeen in recent months. How has that affected you and your team?
Well, it's funny. I've not noticed any changes. We just hired a whole load of graduates, actually, so I've just been saying hello to them just now. And on the investment side, there's been no change. I can honestly say they said that when they announced the job cuts. They said, look, it's middle office and back office. It's duplication. It's things perhaps that should have been done when we Standard Life Investments merged with Aberdeen. Perhaps some of these things are lagged from that era, 2017, and they're now getting done. And I'm not noticing it. And I think that for me, that's the beauty is I'm still attending lots of company meetings. I'm reading lots of good research notes written by my colleagues. I'm putting those to work in the portfolio. So it's feeling. And I thought, so one other point is that we go around, we do meet other fund managers, and it's amazing. If you have other fund managers on, ask them the same question, because I have a feeling that others are now going through perhaps what we did. Perhaps earlier, because of our merger, we got on with it, and we got those changes done. I think those are now happening across the wider industry.
Okay. Well, maybe some of those cost cuts will trickle through into your lower charges as well, which will be good.
It's an important point that if we're going to think about providing a good value for money, we've got to be thinking about the bottom line, and how we can hand that back to clients.
Okay.